Let's also talk a little bit about the state of the economy. Is there a surplus liquidity in the system? What exactly does this indicate? And what is the expectation from the interest rates as well as bond markets? About this and lots more, we have Dwijendra Srivastava, CIO Fixed Income at Sundaram Mutual, joining in. Good morning and thanks much for taking time out. To begin with, what exactly is your view on the surplus liquidity in the money markets? Do you think that it's an indication of risk aversion in the system?
Yeah, I think that's a part of that is definitely risk aversion. I mean, we have seen the credit growth in low single digits. It's about 2-8% from about 8-9% about a year ago. So clearly credit offtake is not there, and I think this is having a background in terms of the NPA rise in the system and the credit events which have taken place. When before the sentiments turn and animal spirits come back again, I think it will be I think at least 2 to 3 quarters before that could happen probably. And this liquidity should drive the credit in future, but I think right now that sentiment is not there, and I think liquidity is also an outcome of the fact that RBI is deliberately maintaining excess liquidity.
Okay, do you expect the surplus liquidity to continue to keep rates lower in the system, in the money markets?
Yeah, I mean, we expect the rate should be around these levels. I mean, the money market curve particularly will be anchored to the repo rate, and we expect the repo rate to be cut by another 25 basis point in the near future. And this is because of if you look at it, the mandate of the MPC is both growth and inflation. So right now, if you look at it, although the headline inflation has shot up, primarily due to supply side issues. Although the core is not the mandate of the MPC, but the point is that there is a negative output gap. And if you look into that and see what are the high frequency indicators showing, clearly the need of the hour is to keep rates low. And still the real rates are high in India. And if we compare globally, I mean, clearly one of the highest 10-year bond yields is in India.
Yeah, exactly. And on the same subject, what about rate transmission? Because that hadn't been happening, and that was the big cause of concern, because even though the central bank had been lowering rates, the transmission into the real economy hadn't happened. Are you sensing that overall transmission has improved from what it was about a month back?
I mean, I think transmission is also an outcome of demand. I mean, I think the point is that at this point in time, the aggregate demand is not there. And clearly, if you want to do that, the growth needs to pick up. I mean, if the growth picks up, automatically the lending should pick up, and even at these rates. So when the point is, this is also an outcome. In definitely, one point is definitely right, that the rates are not being transmitted at the lending side, or the rates are not being lowered. I mean, the primary reason is that there is an impairment in the balance sheet of the lenders. So they cannot lower down the rates too much without taking a hit on their balance sheets. So I think that is constraining them to lower down the rates at this current juncture.
Okay. With the last CPI print coming in higher than estimates, how are bond markets reacting? Do you see further rate cuts coming? How do you see bond markets pricing in that rate trajectory?
Market is pricing another 25 basis point, probably at least 50-60% of that rate cut is already factored in the money market curve. And I think if 25 basis point, because there is a division in the market in terms of what quantum of rate cuts could happen, because the headline is shot up, and with the rate cut cycle beginning in the backdrop of the fact that the mandate is to look at the headline inflation, not the core inflation, I think markets are a little confused that what will be the action from MPC at the current juncture. So I think 15 basis point to 25 basis point is what the market is expecting. We think that since the mandate and the negative output gap hasn't been closed, we think that 25 basis point is something which should get delivered. I mean, I think despite the fact that the transmission is not there, the rates need to be lower, and still the real rates are pretty high.
Do you see rates actually going down further, and would you say that that would be really better for growth, and that's what is needed to try and instill some momentum back into the economy?
So it's debatable, and in the past rate cuts, so we have till now about 135 basis points of rate cuts, and in the last policy, RBI mentioned that there was a rise of 8 basis point on the lending rates. So that has been counterintuitive, the rate cuts. But having said that, what RBI can do is they have very limited tools with them. And one of them is your rate movement, the other one is your liquidity infusion. So I think on both of these they are acting, and this is something which will eventually come handy when the growth picks up. And as I told you, I mean, we are in a backdrop where even a 5% handle of about the growth which we are witnessing is one of the fastest growth in the global arena. So clearly the point is, this is in a backdrop where overall the global economy is suppressed, and the domestic economy is also facing the heat in that backdrop. Clearly, whenever that aggregate demand picks up, and I think the levers on those need to be both policy and policy measures from the government and the central bank. I think central bank has acted on its part, and I think more needs to be done from the government. They've already on that job. I think more we will see more action from the government in the coming times. I think this fiscal lot of constraint is there on the fiscal space which is currently existing. I think when that opens up, you would see more measures.
Very much for joining in and giving us an overall view as to what exactly the macro picture is and decoding the surplus liquidity.